Coming back on point, I always look for silver to confirm gold's move. It always concerns me when we don't see silver and gold not moving daily together, but when you have a very strong gold market and silver isn't participating, that gives me pause. And we're now seeing it take place. We are in a new era. We are in what I consider the third and final leg up in the precious metals. This is the leg that lasts. Actually, the duration is not that long usually, but the price appreciation is phenomenal.
Gold and silver prices have surged to new highs due to a combination of escalating geopolitical tensions, particularly in the Middle East, concerns about the upcoming U.S. election, and growing expectations that central banks worldwide may enter easing cycles. These factors have driven up demand for safe haven assets as investors seek to protect their wealth against increasing uncertainty. Gold, in particular, has reached record highs, while silver is also benefiting from increased industrial demand alongside its safe haven appeal. Silver prices rose on Tuesday to a multi-year record high of $34.40, the highest peak since August 2012, and a 1.81% increase from the $33.79 it cost to buy an ounce of the gray metal on Monday. Silver prices have increased by about 45% since the beginning of the year. All year, analysts have been calling for higher silver prices based on the metal's performance during previous precious metals bull markets. When gold prices take off, a silver rally is often not far behind, a phenomenon that has been seen several times in the past. However, this catch-up rally took longer than expected in 2024. While gold prices have made new all-time highs several times in 2024, since first hitting a sudden peak of $2,100 in December, silver has had trouble breaking past the $32.50 resistance. That has since changed, buoying expectations that this could be the massive silver rally stackers have been awaiting for decades. David Morgan, the publisher of the Morgan Report, is optimistic that this is a turning point for gold and silver. In a recent interview with Liberty and Finance, David explains why this is a historic moment for gold and silver, adding that this is the moment we may finally see silver hit new all-time highs. As we present clips from David's interview, please take a little time to like this video, subscribe to the channel, and turn on the notifications bell for more videos like this. We appreciate the support and hope you enjoy the video.
Talked about gold being a barometer, not a thermometer. Gold really forecasts the future in a lot of ways. And, how many of us for, decades or more have talked about, deficit spending and problems with fiat money and the trust in government, confidence in the dollar's reserve currency. I mean, all the things that we've discussed on your show and many like these for years, we've really seen the metals, do both well and not so well. I mean, when we started in 2000 at gold at 252, we're over 10 times that amount right now in fiat terms. But in actual, real, true purchasing power, we haven't really gained that much. That's why when people say gold's making new highs, yes, it's nominal. The number 2,700 is a lot larger than 2,000. It was just not that long ago. What is it in real purchasing power? It really has not reached the all-time high of 850 back in January of 1980. So that's point one, but let me get more specific on your question. Coming back on point, I always look for silver to confirm gold's move. It always concerns me when we don't see silver and gold not moving daily together, but when you have a very strong gold market and silver isn't participating, that gives me pause. And we're now seeing it take place. So there's very little upside resistance beyond 33. As many people have stated, it's a fact. And, we're going to get to 50 this year. I highly doubt it. Will we see 40 this year? I don't know. What I do know, I started trading futures and got so much into the hard money, sound money camp and been there my whole life, basically, my whole adult life. One of my first brokers said, nothing moves like silver and soybeans. Not that you need that comment, but the idea being that they can move very rapidly. And this is true. And so it can just, as I said and coined the adage many years ago on Financial Sense News Hour, silver will scare you out or wear you out. And scare you out is like if you're in a leveraged position and you're long and if you're long and it goes short or drops rapidly, it'll scare the heck out of you. And if you're on the other side, it does the opposite, it'll scare you. And then it could just do nothing for a very long time or slowly grind out like we've seen so many times. So people just get fed up, I'm doing this. And that has to do with kind of an investment attitude and buying too much, buying the wrong kind or buying the wrong time, or not taking a long-term view or really understanding what these markets are about. So I answered probably a bit long-winded, but we are in a new era. We are in what I consider the third and final leg up in the precious metals. This is the leg that lasts. Actually, the duration is not that long usually, but the price appreciation is phenomenal. And this is where you get that adage that, actually Jeff Christian mentioned it to me many, many years ago, 90% of the move comes in the last 10% of the time. And of course, I actually did the math on that. It was about 87.5% of the move came in the last 7.5% of the time in 1980. From 1965, when silver was demonetized in the U.S. at $1.29 an ounce, it took till January of 1979 to reach $6 an ounce, and $6 an ounce 1 year later it was at $50 an ounce. Be it one day, it was only a one-day $50 print, but nonetheless, it did trade at that price, which is 8.5 times higher, and that took 1 year. So if you do the math, as I said, it comes out basically 90% of the move, not 10%. It does not guarantee that this market will do that exactly, but it does infer strongly that the last leg up, as I just said, will be the strongest in price appreciation and probably will take the least amount of time.
Analysts are particularly bullish on gold and silver, predicting that its upward trajectory is likely to continue. The combination of geopolitical risks, fears of inflation, and potential monetary policy changes create an environment where precious metals like gold and silver are expected to thrive. As central banks in many major economies may soon pivot to looser monetary policies, further inflating fiat currencies, precious metals become more attractive due to their historic role as a store of value. During his interview, David explains that gold and silver are money as well as stores of value. While many business owners will accept silver in exchange for goods and services in the United States, David says this is nowhere near advisable because of the huge discrepancy between the metal's price and true value. According to David, despite trading at record all-time highs, gold is nowhere near its true value. The analyst believes gold should be trading at $20,000 per ounce in 2024, putting silver's true value at $500 or higher. Most importantly, David says these valuations are coming much sooner than people anticipate. Let's get back to the interview.
When I, got involved on the internet in, 1998, and about 2000, I wrote an article called "Engineering the Price of Gold." Everyone wants to know what's the paper price of gold? And in theory, it's very simple. You just take for the U.S. what the purported amount of gold is and the amount of M0 base money dollars out there, and it's how many dollars versus how many ounces. It's a division problem. It came out 2,500 the ounce, and now 25 years later, Jim Rickards just did the same, arithmetic. It's a division problem. Then it came out 27,000 the ounce. Believe it or not, and this is the hardest concept, and I want this to get out first before I'm going to answer your question fully, is believe it or not, in terms of paper versus metal, you are actually buying gold today in today's value of $1, very similar to what you were buying in the year 2000, because the money supply has gone up that tenfold in those 25 years. And so to tell someone, well, David bought his gold at, 300 and, now it's almost 10 times as much. Wow, he's made a killing. Actually, I've preserved my purchasing power and I have not made a killing. But that's an extremely hard concept. But to get the one, and I've had I'll call it an argument. I've had discussions, heated ones at times, with certified financial planners. I did work for one early on in my finance career, but the best studies in the world will show you on portfolio analysis that you must, and the word is must, own gold in your portfolio if you want maximum performance. And everybody wants maximum performance. And not only do you want maximum performance, you want maximum performance with the least amount of risk. Ibbotson and Associates did a study. I was funded by BMG Group, my dear friend Nick Bereshef, who's no longer with us, and the number's 15%. Jeff Christian of CPM Group did it from 1968 on, and the number was 25%. And people like me recommend about 10%. And that goes back to what I said earlier about, people buy too much, buy the wrong kind, or jump in all at once or whatever. But really, it's been proven time and time again that factually, objectively, without any emotion, that precious metals are required. And this is what's sad about the financial planning industry, because they never are taught this. There could be a day when some of their clients lose a great deal of money in the stock market, and they listen to a show like yours and say, my goodness, if I would have had 25% in gold, I'd be in the positive right now, even though the stock market took a massive decline. Or, the bond portfolio got wrecked because of interest rate fluctuations. But if I had gold in my portfolio, I'd be even. So I think I answered. The last one I want to say is I wrote a 10-pointed one-pager called 10 Rules of Silver Investing. And that's on the web. You can type in David Morgan, 10 Rules of Silver Investing. It applies to gold as well. And those 10 rules will keep you out of trouble. And, I won't go through every one of them, but, it talks about starting small. In other words, don't jump in all at once. It talks about dollar cost averaging. It talks about buying the right amount. Okay. And it was try to be pithy, like cough medicine, too much is too much, right? You need the right amount to get over your cold. So you need the right amount of precious metals to balance out and have a happy life. To me, and I don't like calling it insurance, but you can call it that. I really don't care too much about what you name it. But the idea is to have balance in your life. Like if you overeat, you're going to get fat. You undereat, you're going to be malnourished. Where's that happy point? And that's the same thing with precious metals investment.
David Morgan's 10 rules of silver investing are: Rule 1, when all else fails, there is silver. Rule 2, start small, keep it simple. Rule 3, boost the buying power of your dollars with mining shares. Rule 4, dollar cost average to lower your costs and increase your discipline. Rule 5, do not get a raw deal from your dealer. Rule 6, what's yours is yours, so keep it that way. Rule 7, silver speculation is like cough syrup, good in small doses, but too much can make your portfolio sick. Rule 8, a little information can mean a lot more dollars. Rule 9, collecting silver is an art, but not really an investment. Rule 10, more than 10% is too much of a good thing. In other words, when all fiat currencies return to their original value, which is zero, silver will remain the world's money of last resort. So, when all else fails, there is silver. Secondly, don't stack more than your risk tolerance can bear, and stick with pure bullion bars or coins that have high resale value, especially if you are a beginner. Look into mining shares and use the dollar cost averaging method to gradually increase your holdings. In addition, get a trusted dealer and decide the best way to keep your metal without forgetting Executive Order 6102. Finally, measure your risk tolerance and invest appropriately. Too much, too fast is never advisable. Are you buying silver, or what's your exit strategy for when shit hits the fan? Let us know your thoughts and replies in the comments section below. If you liked this video, don't forget to share it with others. Give it a thumbs up and subscribe to the channel for more videos on gold, silver, and other metals and commodities. We appreciate the support and hope to see you in the next one.